You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
I'd like to introduce Greg Stevens of Fidelity, and he is our a great moderator for the panel, and he'll take it from here. Greg.
Well, we'll have to see about the great moderator thing here before that's a lofty goal for me today. But good morning and welcome. Hope everyone had a good opening night at the Wild Horse Saloon. Special thanks to OIC for putting that on. We had a great time for sure, and looking forward to today as well. So, as Antonio mentioned, my name's Greg Stevens. I work at Fidelity Investments. I'm Vice President of Options, at the firm there. Today with me, we've got Feeney, from Nasdaq, Ravi, Jain from Sterling Tech, and also Ming, Zhao from Atomic Vaults. Got a great panel discussion today. We're going to be looking a little bit at where the retail investor is today and where they might be going in the future. But before we get started there, why don't we just take a moment and hear from our panel. Just quick introductions.
Sean Feeney, I lead the options business at Nasdaq. Been at Nasdaq for around 6.5 years. Been in the industry around 25.
Ravi, Jain. I've been in the options industry for several decades as on the trading side, vol and quant strategies, risk management, and as a technology innovator. And now I am Chief Product Officer at Sterling Trading Tech.
Hi, I'm Ming, Zhao. I'm the co-founder at Atomic Vaults. We do fractional options for retail. We work with brokerages, and before this, I was at Point72 as a long-short analyst.
All right. Well, thank you. And let's get started. So we want to kick this off, thinking about, as we think about this past year, we've had a very different trading environment, from, say, really, the previous 5 or 10 years. Markets have been volatile. We've been in and out of bear market territory. We've seen an interest rate environment where the Fed is raising aggressively to fight inflation. Many of our first-time retail traders, haven't seen this, and quite honestly, many seasoned, retail, investors haven't seen this as well. So, Ravi, with this as our backdrop, what are you seeing from the retail investor?
Sure. So, clearly, we had that big retail revolution, as we referred to in one of our conversations. Yep. And that's somewhat, we've seen a little bit of downturn on that. Retail investors are there's a little dip in activity. There's seems to be a subtle shift from the high volatility names to ETF or even indices. And so it begs the question, was the whole retail revolution flash in the pan and is not sustainable or is not going to continue? And I think that's probably on a lot of people's minds, So I'd like to take you back about 23 years ago when I first co-founded iVolatility. Back then, we had predicted that the retail revolution is coming, retail options is coming. Of course, the dot-com crash happened and we were wrong. And we had to wait almost 18 years before it sort of came back. And this time I think it's extremely different. First of all, the barriers to entry are extremely low. It's frictionless to open an account, start trading, and be on your mobile all day long wherever you are and trade. Secondly, there's a tremendous amount of awareness among retail. Every youngster I speak to knows about options. They've heard about options from their friends or from social media or whatever they're, chatting with other people on. And so they're fearless about trying and playing with a little bit of money and investing, trading options. And then, of course, the industry has recognized that they're a real force, and they've responded with products, with services, et cetera. So, and of course, we know that the pandemic was the perfect catalyst to just blow this thing up. So, given all that, I think the retail participation is here to stay. I don't think it's going away. I think we're going to see some ebb and flow and dips, but I really think now it's a real force, and it's going to stay.
Yeah, I think if there was any question on whether the retail investor, the new investor, the young investor are here to stay, I mean, has been answered over the last couple of years. Ming, how about you?
Yeah, I completely agree. So I have some firsthand experience on the social media sites, observing what the new retail likes to talk about online and how they, socially trade. So I've seen, the TikToks. I've also seen, and I also post on Twitter. And there's tons of interest on inflation. There's been tons of interest on Fed, and everyone is surprisingly very well educated, I think, compared to 10 years ago, let's say. And the age at which folks have started trading has also been a lot younger. And even though these kind of new traders don't have a ton in wallet share, that will certainly increase over time. And even though, we can call it, if bear markets today and 2021, bull markets, whatnot. Yeah. And even though if we compare to 2021, the volumes might be lower. I think it's kind of a rising tide floats all boats scenario where the highs are higher, the lows are also higher. So definitely, I think, here to stay as well.
Yeah, I think it's interesting that, education's really led this effort in communication. And, Ravi, to your point, the barriers to entry are much lower than they were 5-10 years ago. And, social media is, the thing that I focus on a little bit because that's where, a lot of information is being disseminated. And I think firms, if they weren't there over the last couple of years, they're there now. We started to see even at Fidelity, we have accounts on all the social media, making sure that, in Reddit, if a thread starts, that it doesn't get a million posts, or a million looks, without having the right information in there. So we have to really be where they're at and focused on what we can do to support, this group. Sean, how about you?
Yeah, Ravi mentioned, the boom, and that really started in 2019 with the reduction of commission costs, and then all of a sudden we find ourselves in the pandemic era. And then through the pandemic era into the meme stock revolution. And then through that into what was the peak of retail volume was right around July of 2021, where retail was on one side of around the mid-60%, 63% or so of all option volume in the multi-list space was absolutely pure retail. Classically, that's been somewhere in the low to mid-40s. Right. As far as overall retail volume as a percentage of the market. Some of that's not necessarily your average, trader that's either performing, yield enhancement strategies or portfolio protection, or, we've certainly moved into a meta where today we have a bit more speculative trading. There's a lot of volume, and the duration of the retail investor cycle has continually shortened over time. 50 years ago, there were 3-month, 6-month, and 9-month options. 50 years and 2 days ago when options were launched. And the first option contract traded in Xerox. I think it was the Xerox 160 call. And it was the July 160 call in Xerox. And, I think we'll get a little bit into how they trade these options a little bit later. But that's been the experience so far. And the last 18 months has seen a slight decline in that percentage. But we're still hanging in the mid-40s.
Yeah, I think we still, we're seeing really good participation from the retail, from the retail investor. And I think, Ming, you mentioned something about, the rising tide lifts all ships, and same thing when it moves lower. Typically in down markets, people have a little less to trade. They pull back a little bit, and I don't think it's. I think Mr. Schwartz mentioned something yesterday about. Overall retail volume being down. I think it's just a natural ebb and flow. I think, when we look at this group, we had a question that we were looking at that said, will involvement of retail, will it persist and grow, or is it fleeting? And I think that what we're seeing is we think it's going to grow, but it's going to have the highs and the lows that we're seeing today.
It's the education, it's the frictionless experience, it's the tools that are available to the retail trader today that far surpass the tools that I started using on the floor in 1999. Right? I mean, retail traders have that at their fingertips every single day, and they can do portfolio analysis that I couldn't even dream of when I first started.
Yep. And it's a response from the industry, new products, new technology, et cetera. Without the industry responding, you lose the interest of the retail. Yeah.
Agreed. All right. Well, we want to shift focus just a little bit, on the retail investor and talk about the risk in the markets today. Mentioned that many of these new and even some more seasoned retail investors haven't had a real opportunity to see a market like this where it's moving down or it's very volatile. Interest rates are playing a bigger part in that. Ming, as an educator and entrepreneur, what are you seeing, the retail, investor? I mean, you're on social media, you're seeing, them, talk a little bit more about that. But how are they looking at risk?
Yeah, as mentioned yesterday on a panel, when you have very little, you're extremely vigilant about asset allocation. You're extremely vigilant about, my position. I can only have this much go into this position because otherwise, I can't diversify, and that's a problem. And I think a lot of them have experienced gambler's ruin for what it's worth, very early on in the pandemic, if that's when they started. Mm-hmm. So now they're hyper aware of that, and in order to diversify their portfolio, and that's one of the goals now, I think, is because they're like, okay, I got, either I, kind of got screwed during the meme stock or whatnot, and now I have to change my ways. And maybe some of them are doing passive or trying passive, but everyone likes to have their own views, so kind of going back intermittently to active and just kind of broadly just diversifying now. Like there's a lot more interest in stocks like Costco. It's not just tech anymore. Right. So.
All right, Ravi. Sterling. Sterling's uniquely positioned to help firms, not only retail investors, manage some of that ongoing volatility in the markets. What are you seeing?
So we're seeing on the risk side a significant amount of interest in risk technology from the firm side, because on the actual retail client, they're predominantly long options. So there's no market risk and credit risk, really. The risk that their accounts pose to firms or to brokers and clearing firms is the exercise risk. And that's really something that we're seeing a lot of attention being paid to. Before, if you had a few contracts, not too many clients who had options that were in the money, you could manage it more or less manually or with limited amount of technology. Today, with retail brokers having lots of accounts and lots of expirations, every day they're dealing with this issue of how to manage expiration risk so that a retail client doesn't get into an exercise that they don't have the equity to support. So we're seeing a lot of interest in that. On the long side, just long, it's pretty easy calculations. But as we're going to start offering, as the industry starts offering spreads and even shorting of options, the calculations become much more complicated. And some firms have responded to this by just saying, we're going to shut down or liquidate at 2 o'clock or 3 o'clock. And that's not necessarily the best experience, because if investors bought an option that expires at 4 p.m., they want to be able to hold the option to last close to 4 p.m. as possible. And so the solutions have to be technology solutions that can automate that, automate the closing out, the liquidation, et cetera. So we're seeing a lot of interest from that perspective. The other side is, retail might be buying a lot of options, but then somebody's selling to them. And so brokerage firms are finding that a lot of their normal traders, prop traders, semi-professional traders, et cetera, they're the ones who are taking the other side, and they're building large short positions on these options. And so firms have had to really up their game in terms of risk management, real-time intraday risk management, systems that can create better internal house policies is becoming really, really important. And then lastly, and probably what I think is probably the most important, is proactive risk management. We're not seeing enough of that, I think. We're seeing a lot of talk about that in terms of proactively reducing leverage on the high-risk names, The industry brokers still tend to be a bit reactive. They, when after the fact, they'll jump in and start, raising margin rates or reducing leverage. But I think it's going to be important to be more proactive on that so that you prevent the retail traders or prevent your traders that are taking the other side to get into trouble,
Right. Yeah, I mean, in JJ's panel, they mentioned operational risk, yesterday, and some of the volumes that we've seen from retail, investors come in. I think, I don't know if it caught us by surprise, but it was definitely something that we had to, take a look at. And with all the additional accounts, with the risk management that comes with that, can the account support an exercise? Can it, support an assignment? If naked at that point, take some real-time calculations and to be able to do that quickly. If you weren't automated, in that process, you needed to get there quickly in order to, be able to just to manage the influx of accounts. Or you're in that situation where you have to do something a little bit more dramatic, and whether that's shutting down trading at 3 o'clock, 2 o'clock, start liquidations much earlier than you might have in the past. You had to get in front of this this quickly, and I think as an industry we performed really well when it comes to this. And with just the additional volumes that came in, I think they mentioned 50 to 60%. Of average daily volume, 0 DTEs now, and we'll get into that a little bit more in a bit. But you have to be on top of your game. One follow-up, Ming and Ravi, for you, as well, is we mentioned that we're long only, or we're predominantly. It seems that. I mean, have we seen a shift, from that retail investor to doing a little bit something more complex, like a spread, making that transition?
I guess I'll start with that. I think so. Before I get to spreads, there's speaking of long only, there's I guess also a difference in complexity. I guess kind of in the retail trader's mind between calls and puts.
Right.
Not surprisingly, maybe this is tied to when options came out. As stated yesterday, only calls were available, so everyone thought up only market. So 2021, everyone thought, up only market. So a lot more call volume than puts. And then when the downturn happened, just straight up buying puts was one of the very few ways that a lot of retail traders had to express a bearish view on anything. So I think overall just general kind of increase from or evening out between calls and put volume. I think that the majority of retail traders, at least that I've seen on social media, are not yet, if they were not at the point where they were doing spreads, if they were kind of like still 1 to 2 years in their investing experience, haven't yet gotten to spreads. But obviously I know there's tons of platforms that are spreads focus and focus on essentially converting or catching the trader that goes from just long only to more complex strategies.
And the increase in more complex strategies being employed by retail, it all kind of ties in, right? Because that introduces some of this operational risk. Short a call spread moves to a strike, don't have enough money in the account in order to cover physical delivery, et cetera, right? So, the proactive risk management on an intraday basis towards expiry that the retail firms have needed to employ, definitely poses operational risk. Additional risk around the expiry cycle and specifically what might happen after the close, given the access to the retail investor about what they can do post the close and post what the expiry date is, right? So contrary exercise intent notification isn't something that's necessarily often spoken about amongst the retail community. As the more complex strategies being employed by retail continue to expand, we as an industry need to continue to step on the gas as far as our educational effort. Naturally, Ravi mentioned retail tends to be long convexity. So from a From a market risk perspective, that tends to be muted. Just naturally being long options, you can only lose the premium that you spend. But then, it's about strike selection and portfolio optimization, more so today than it has been in the past, right? Where it would typically be, I'm long a stock, I need to generate additional yield on the stock, I'm going to sell an upside cover call, right? So, and that education has run its course, and we've seen, a tremendous amount of growth, and a lot of the wealth management and RIA community, which is still retail, only a different style of a little bit more sophisticated retail, and certainly not pro-tail, as we kind of further segment the segment down, into these kind of microcosms of activity. But when we're thinking about risk top down, I think that we do an amazing job as a industry in that educational effort, but we need to keep pushing hard and making sure that not only the information is out there, but that the right information is out there, accurate information is out there, because there has certainly been quite a bit of rhetoric in the media, especially as of late, surrounding some of the risk items and potential systemic risk items to the market that are either pure fiction or just a great headline, or clickbait or whatever. So, we're on the right track. Keep down the road.
Yeah, I mean, I think it's important. I mean, you mentioned, education, and, we all have to do our part. It's a partnership between, firms and, the exchanges and everyone who's involved, especially to get the right information out, at the right time, whether it's, a corporate action, because we've seen a lot of, we've seen a lot of posts, about, the recent activities in the corporate actions, what is it, how does it work, and, the information, can really go the wrong way really quickly. And so all of us, doing our part, I think, we've done a really good job of getting the right information, out at the right time to the right people. And we need to continue to do that. We have to meet, these retail investors where they're at. If we don't, whether that's social media, on our platforms, engaging them as they're going through the process, making sure that they know an earnings announcement is coming. I mean, one of the common, questions we get is, well, which expiration do I choose? What's the right process, for that? And if you're looking at an option chain, I mean, it is very much intimidating to that new user with all the strikes, all the expirations, and we have content on our website that helps you at least start to define that process to make sure that we're getting because the worst thing for them to do is to choose the wrong one, lose some money, and then we may have lost them for good at that point. So constantly engaging, constantly doing the education is really important.
And one thing that we haven't mentioned just yet, that tends to get referenced because each year it becomes more and more true. The retail investor has never had it better. We have a great market structure in this industry today, right? And we spoke about market structure and what's happening on the equity side, how that might filter in to the option space within the next few years. But the wholesale construct that we have within this market today works wonders for the retail participant. They do receive a tremendous amount of price improvement. The experience that they're getting continues to be positive. We see the growth because of that positive experience continue down a path to more continued growth, and the introduction of new product is really what's taken us on this next leg up. We're up as an industry, over 100% in the last 5 years as far as our overall market volumes, and that happened precipitously. And due to a host of outside factors, but also because of the work that's being done by everyone in this room in educating the constituents, or let's say the participants of this industry that either aren't here yet, need to know a little bit more, are investors but don't understand much about options. And that education that we continue to do is just it is paramount to continued growth of this industry.
All right. So now we want to take an opportunity to do a little look back, but then also to look forward, what's to come, within the options market for the retail investor. And one of the topics that has been ongoing, at this conference, and no, it's not strike price proliferation. It is actually zero DTEs. Sean, I want to start with you here. I mean, how has, that changed the market, and how is it going to evolve the market going forward?
I have opinions. I actually want to get a little crowd participation. Repeat after me. 0 DTE is not a product? No, nobody? Okay. It's a point in time. It just so happens to be the point in time on the last day of an expiry cycle. We understand that as professionals in the industry. The general public does not, right? So it is so important for us to educate on 0 DTE and specifically the last day of an expiry cycle. And as we start to introduce additional product that might increase the amount of quote-unquote 0 DTE trading that is occurring, just to throw out some statistics, just looking at names like Amazon, Apple, Google, Netflix, and Meta, if you go back to well before the volume increase, and you look at just the Friday, you look at the volume profile of those symbols, which were the most actively traded equity symbols in the market, 40% of the option volume in those symbols, going back to, I want to say 2014, I think is where I looked at data from, it's around 40% of the volume on the day of expiry. Well, guess what? We're going to introduce additional expiry cycles, and I'd really love to change the way that we're talking about things like dailies, because these are not daily options. These are weekly options with non-standard expiries, non-Friday expiries. They're listed anywhere between 2 weeks and 3 years in the past, and then they happen to expire, right? So as we introduce expiry cycles that are going to expire on Monday, Tuesday, Wednesday, Thursday, we're going to see an increase in the amount of options that are traded on those days. It isn't alarming. Again, retail is long convexity. So from a systemic risk perspective and from the retail lens, there is no additional systemic risk added to the marketplace in that construct. When professionals are absorbing this risk and institutions see that volatility is leaking higher because there is a outsized amount of buying in the marketplace, they're going to step in as institutions, be they prop, be they fund, be they market makers, and they're going to push the volatility back down through selling options to stasis, and we find equilibrium, and that's markets, right? And those professionals are amazing at managing their own risk, through their own firms, risk management processes, and we haven't seen a market maker in the options industry have a really significant issue because of poor risk management. Everybody does a great job at staying afloat. We have seen entrants kind of come and go, but the market conditions have gotten more difficult over time. And the increase in 0 DTE trading it has certainly squeezed margins a little bit. Spreads are tighter. There's plenty of liquidity, and we're off to the races. And I'm certainly open to contrary feedback or input, and I'd certainly want to hear from my fellow esteemed panelists. But that's my 2.5 cents.
Yeah, I mean, 0 DTEs definitely have an image problem. I think JJ mentioned something yesterday about PFOF changing that as well. He doesn't like payment for order flow. Maybe we can, start 0 DTEs, an upgrade, to their image. But they've definitely filled a gap, right? I mean, if there was a need in the market for something like this, otherwise we wouldn't see the volume coming into those. And so I think responsibly and with what we've been doing as an industry, we can support this.
And when it comes to product introduction, we are being responsible, right? We as an industry. I'm not just speaking from a Nasdaq perspective. As much as we have kind of driven the bus on the introduction of new product. We listed the Tuesdays and Thursdays in SPY, and what we do as exchanges is we gather the input from the industry, and we make sure that we're making responsible decisions in congruence with everyone's feedback, and we're going to push product. We're not going to be listing 5 delta binary 20-to-1 payout options on Tesla. We're just not going to do that, right? I mean, so we're in a place today where there appears to be a significant amount of demand for additional product, and whether it goes down the quote-unquote single stock dailies, which again, weekly options with non-standard expiries. Not going to use the term dailies. We're not listing these products the day of or the day before they expire, right? So we're giving the industry an opportunity to absorb the information, to develop their risk tolerance, and then develop strategies with which to employ, with which to deploy capital, either from a retail, institutional, or we'll call it professional, lens.
So, Greg, you mentioned, as it pertains to zero DTE options and the growth of those, you mentioned the operations risk. And I think one of the challenges in the industry that people are trying to get around to is a lot of the processes in the industry tend to be end of day. Mm-hmm. And when you have an end of day process of whether it be allocations or whether it be margin calculations, et cetera, and you're doing that on something that's already expired, it's a challenge. And so for a lot of the firms, retooling their systems to be able to handle trades that expire even before their reports run, et cetera, is going to be important. And before we're going to see the massive growth of this, I think we're going to have to see some evolution of those back office and operational processes.
Not to monopolize the conversation, but I was talking to a dear friend that I had met on my first day on the Amex floor in 1999, and he walks up to me and he says, if you list these single stock dailies, it's going to be it could be a real problem. And I think the largest risk to retail at that point is naturally corporate actions, events, or news that happens on Monday, Tuesday, Wednesday, or Thursday, because there is this de facto embargo on news events that typically happen on Fridays, like an unspoken, we don't announce corporate events on Fridays during expiry cycles and triple witches, et cetera. So the biggest risk would be after hours moves and what could happen after hours. Professionals are allowed to exercise options, and then whoever's short them subsequently be assigned on options between 4 and 5:30 p.m. And an elegant solution, if we were to go forward on the path to listing additional products on Monday, Tuesday, Wednesday, Thursday expiries, would be to potentially, and I know that the clearing firms in here are going to give me a little stank eye when I say this, collapse the window for contrary exercise intent notification to something like 4:05. That might be an elegant solution. But, we're all talking about this. No decisions are being made in a vacuum. No exchanges is going to be filing with the SEC any kind of product, without some consensus. And the products that are currently in existence with these non-standard expiries, there are exactly, we'll call it 6. As far as 3 equities, or 3 multi-list equities, 3 and 3 index complexes, right? So SPX, NDX, and RUT, whether it's Monday, Tuesday, Wednesday, Thursday, or Monday, Wednesday, and then you have Qs, IWM, and SPY. Those are the only products that have non-standard expiries today. And I think there's room for additional products there, whether they be natural hedge futures, correlated products that professionals can kind of duck and weave out of the risk of those instruments by utilizing other asset classes and other instruments, or other equities that might be available for natural, highly correlated hedges. I think there's plenty of room there. And then the single stock conversation, again, incredibly responsible with a lot of feedback and continually asking, how can we provide the right product that traders want to trade and that would be palatable to regulation, palatable to the retail firms and their operational risk items, palatable to the market-making community and their risk tolerance, and that would see additional demand. And so far, those alternative expiries have been wildly accretive to the volume profile of the industry and has helped us on our path to 100% growth in 5 years.
I have to jump in. Oh.
Yeah, Ming, please.
I have to jump in here. I feel like, we have to ask ourselves, also super excited about the zero DTE. Essentially, we have to ask ourselves, why this surge, essentially? So is it because people are really excited about the exercise? Or is it because people just have small wallet sizes in retail and they want to diversify, and so they want to trade these, what they can afford because they can trade 20 of them. They don't have to just put on one position and then that's it. Everything is locked up in this 1 or 2 positions. So very complementary to everything that you've said, Sean. We're also trying to build a solution for that. So we're trying to build fractional options. It essentially solves the same problem of retail traders just saying, I can allocate 2% of my portfolio in a single position because now I can buy 1/100th of Tesla, Google, Amazon, etc. And actually, when we started Atomic Vaults, kind of right before a year before the huge boom in 0DTE, we conducted surveys with about 200 retail options traders found on Twitter, and 90% of them, we asked just one question. It was, have you ever wanted to trade Tesla, Google, Amazon, whatever strike you wanted, your initial strike, and you looked at the price and you said, I can't afford that. Or maybe I can afford that, but it's going to wipe out, or it's going to, clog up 20% of my capital into a single position, and therefore maybe I'll just go super far out in the chain, or maybe I'll just not put on this position. And nearly 90% of people said, I've had this problem. I either went super out in the chain, or I just, didn't put on the trade. So even, I guess, before that, we could have probably predicted that folks, they want smaller options, essentially, is kind of the underlying theme.
Yeah, and so the product that you're bringing to market with the fractional options is going to be complementary to the existing products. It's not net new, but you're working on a way to break those contracts up for those smaller wallets that may want, maybe not a 0DTE, but you're talking about some longer term expirations as well, right? Focusing on those.
Yeah, definitely. In our surveys, we also found that about 25% of retail traders we interviewed said they want to buy Google or Amazon Leaps. Yep. And so that was one thing, just kind of naturally people brought it up themselves. We didn't ask any questions on that. So many folks were talking about Leaps. And we looked at the volumes, we're like, Leaps definitely do not cover, 25% of options volumes. Is there no demand for it, or can retail just not afford them, and that's why? And maybe worth, trying to change the industry to allow them to get access to Leaps. So definitely have seen that.
So I think, we're running up on 5 minutes. We were going to take some questions from the audience, if anybody has one. But in the meantime, just wanted to say. So we've talked about 0DTEs, fractional options. What other products? Do we see on the horizon for the retail investor? Is it extending hours of trading? Is it international? I think, Ming, you've got some work you're doing on the international side. Ravi as well. Any thoughts on that?
So, obviously we've mentioned the fractional, which is really, really interesting, and the Leaps that's a fantastic piece of information I didn't even know about. And of course the shorter duration. So I think we've covered a lot of the new products that seem to be of interest. But contrary to what you said, I think actually there might be, in the longer term horizon, given the retail investor, I think things like binary options might be actually quite interesting for retail investors, as opposed to spreads where you can't actually monetize it until you go either deep in the money or go to expiration. Binary options.
I love that 5 delta Tesla product.
Yeah. So I think that could be, but I think that's much further in the future because there's regulatory issues, et cetera. But I think that would be a fantastic product for retail eventually.
And Greg's doing a great job of setting up the next panel, talking about just the international expansion, right? So, and if you look at, kind of also staying with the topic on shorter duration trading, if you look at the open interest profile from the 1 day to expiration to the 0 day to expiration, if you just look at the overall growth of open interest over the life cycle of an option, between day 1 and day 0, there is a significant drop-off in open interest. Mm-hmm. And part of that is due to many international firms, many international retail firms, not allowing their traders and participants to hold options on the date of expiration, and making them actually liquidate those positions the day before. That's part of that reason, but also natural closing, which also reduces the risk element. It's amazing.
All right. Any questions from the audience? We maybe have time for one or two. All right. Well, then what I would say, any final comments from the panel that you would want to share as we're almost done here?
I've talked enough. I yield my time.
I guess on the international topic, since it's a good segue anyways, a lot of interest that we're seeing in a lot of neo-brokers popping up in Asia. I think Asia will, if I were to predict anything, usually my predictions are wrong, but I have high confidence about this one. I think that Asia is going to be a huge driver in increase in options volumes in the next couple of years.
I think the last thing I'll say is that we saw a huge growth in the retail participation, and I think we're seeing now sort of a graduating class from that first wave of participants that are getting more educated. They've burnt their fingers on some of those options, and they're demanding more, of course, ability to trade spreads, to short options, but also better tools and better analytics. And so I think from the industry, we're going to see, especially from the technology industry, a lot more sophisticated tools on their phones that they can use to analyze and up their trading to a more sophisticated strategies. I think we're going to see a lot of that.
All right,
we've got another minute. Why not? Asset class expansion into potential, dependent upon how the regulatory regime shakes out, potentially moving into some more leverage and or optionality style products on digital assets. There's already been a significant amount of growth, especially on the retail side, in the futures landscape, trading more index and ETF options, different types of ETFs with option wrappers, right? And just to kind of go back and circle back, zero DTE and the phenomenon that is that rhetoric, for the risk that's introduced from these products, is not Volmageddon 2.0. It is that there is no comparison, zero correlation between any of the data that we've consumed and distributed. And Nasdaq has a few blogs coming out in the next couple of weeks. Check them out. Shameless plug.
All right. Well, I think that's it for us. Thanks to my panel. Thanks to the OIC, Julie, Trish, for putting on a great event, and thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.